In this presentation, we're going to take a look at invoices and how they relate to bank feeds. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to go to the reports down below, and we're going to be opening up our balance sheet report and income statement report, starting with the old balance sheet. We'll change the dates up top, those dates being from January. Let's make it all the way till the end of the year because that's the easy thing to do, 12/31/20. We'll go ahead and run that report. Then I'm going to go back up to the tab up top, right-click on it, and duplicate that tab. Back to the tab to the left. Let's do the same thing for the P&L, the profit and loss, the income statement. Going to the reports on the left-hand side, opening up the P&L. Changing the dates up top. We're going to change the dates up top. Let's just do the month we're working in here, 04/01/20 to 04/30/20, and then we'll run that report. Then I'm going to right-click on the tab up top again and duplicate it. Then let's go to our banking on the left-hand side, opening up those bank feeds. We're left with just the deposits. Now, as with the last time, we're going to be thinking of deposits as basically being from customers unless there's something that was a loan from the bank or if it was something that was deposited from us. So we're going to think about these deposits as being from customers. Last time in the prior month, we thought about these all being recorded as income at the point in time we have received them. And again, if we're working a service company or we're working where we get electronic payments, if we're working online or something like that, we're getting paid by Amazon or something like that, then that system works well. But in some systems, we may want to invoice. So if we go back to our flowchart in the desktop version, we might have if we deal with inventory, we might have a system where we have invoicing involved in the inventory. And even if we don't have inventory and we're in a service type of organization, we still might have a situation where we want to invoice. So we want to use the invoicing process, and then we're going to receive payment sometime in the future. So if we want to use then invoicing, how can we put that into our system when the bank feeds are simply going to give us the deposit at the end of the day? Well, either we can enter the invoice and then try to match it up with the deposit from the bank feed, or we can enter the invoice and then record the received payment and either make the received payment basically go to undeposited funds, which is the norm, and then match it up with the deposit, or we can go to receive payments and we can deposit it at that point in time, and then when we get the deposit from the bank, we just simply match them up, or we can go from receive payments to the record deposit, and then again, when we have the bank feed, we just match them up. Now, what's going to differentiate these steps is the fact that if you have an invoice and then you receive payments, if you have multiple payments that you receive and then you go to the bank and group them in the bank in some way different than they have been received, then you're going to have to take this extra step to go. Otherwise, when you look at the bank statement, the grouping of the deposit in the bank statement is not going to give you the detail that you have with the invoices, the multiple invoices that you have received. If, on the other hand, you only get a few payments that come from the invoices and you just like scan them in, let's say they're checks, then all the checks that are going to be in the deposits, you'll see each check in there individually, and you'll be able to they'll show up in the same format on the bank feeds. So in other words, if you have some kind of grouping going on with your deposits before you put them into the bank, then you kind of have to group them and put them in the bank in the same format as they will be seen on the bank statement so that you can tie them out to the invoices. So let's see a couple of these just to see how this might work. So we're going to imagine we're entering an invoice. So let's take this first item here. Let's pretend that this is going to tie out to an invoice that we have made. Now, obviously the invoice would be made before we see the deposit transaction here. We're going to enter the invoice now. The workflow would be we have the invoice and then we see the deposit here. So I'm going to go back and say, what if we had an invoice in the system? I'm going to say new, and we're going to add money in. I'm going to say send invoice. I'm going to pick a customer up top, and I'm just going to say Anderson Guitars is going to be our customer. And then I'll put this on the books as of just, let's say 04/01 04/01/20. So there we have that. And then on the product, I'm not going to choose a product item because that would be an inventory item. So what I'm not going to do is track the inventory in here. I'm just going to simply use the invoice in order to record the billing and send out to the customer. And if there is a product on it, we can use it to help us to calculate the sales tax that would be on it as well. So I'm just going to simply write the description, guitar, and I'm not going to put a specific one in there. And I'm going to say that it was 1, and then the rate I'm going to say is 910 to get us up to there. And I'm going to say it's a taxable item, and let then the QuickBooks system calculate the tax for us, which I've set up the tax in California. The multiple tax is going to be the 86.45. So that means the QuickBooks can help you to calculate the sales tax, the full invoice then being at that 996.45. So let's go ahead and save and close that. So again, I'm going to say save and close then here. And then if I go back over to the bank feeds, you'll note what QuickBooks then has here. It says one record. We have an invoice of the 1045. They're just basically saying, hey, I noticed that this deposit here, this 996, is tying out to this particular invoice of the 1024, because it's basically the same amount. Are these two the same amount? If they are, then we can go ahead and match this thing out. And when we match it out, then the invoice would have recorded an increase to accounts receivable and the other side going to sales. When we match it out, this will of course deposit in the checking account and decrease the accounts receivable. So that's one item we can do. Let's make it a little bit more complex. Let's go back to the balance sheet up top, and I messed up my income statement report, so I might make another one. But if I close the hamburger and scroll up a bit, I'm going to find that invoice and say, let's go ahead and find that invoice and just make it a bit more complex. So here's the invoice on 4/1. I'm going to go back into that invoice and say, well, what if the deposit we had was for multiple different invoices? For example, I'm going to hold down Control and scroll down a little bit back to 100. Let's bring it to 100%. And let's say that this invoice was at a rate of 430. And it's taxable, so that means it's going to be the 4085, so the total is going to be the 470.85. And then I'm going to say save and new. What if I have save and new? And then we have another invoice that was input. Let's say this was going to go, let's just keep it at Anderson here. And then I'm going to scroll back down and say that this is another guitar. This is a different guitar. And we're going to say that we have one of those, and this one's for 480 is the amount, and it's going to be taxable. So we'll say that that's going to be taxable, calculate on the sales tax. That's at the 525. So we had then the 525, and the other should hopefully add up to that 996. These two invoices then adding up to the deposit. And I'm going to say save and close, save and close. And so there we have that. Now we have these two items that were put in place. And if we think about the deposit now, note again, if we look at our flow chart, when we get to the deposit, it might be multiple invoices that we grouped together for some reason. We might got paid by both of those and went to the bank and deposited them at one time. And therefore the bank might only be showing that 996 that's reflecting these two invoices. And that's kind of part of the problem with the flow here when you think about how you're going to match these things up. Let's go back to the bank feeds. And we have this record. It's still saying it found it, but I kind of changed it so it might not be picking it up exactly. But it said it found one record. I want to look at the more detail in that record, and we have the match here. I want to basically find others. So if I look in the others section, notice we have these two items. So we have the open invoices of the two items that would be adding up to that 960. So I'm going to check those off. And the point here is that QuickBooks won't always basically see if there's multiple invoices that add up to a deposit. And that's when you might have to get more, you might have to go through the process more and batch the invoices and actually deposit them and match them out, as we'll see in future presentations. So I'm going to go ahead and save this item. So there applied out those two items. So if I go back then to the balance sheet, and we're going to go into our checking account then, and note we entered those and they were in the bank feeds as a deposit. However, we see it here as a 4-3, and it's not a deposit form. We're using a payment form. So we could see these two items that are going to be input in place as a payment form because we checked off basically those two payment forms. And you'll recall that if we were doing a full service kind of cycle, back to our flow chart, the create invoice and then the receive payment. And we can assign this receive payment directly to a deposit. So what we did is we matched up the deposit that was tying up two receive payments. QuickBooks basically said, okay, I'm going to make a receive payment form as if you deposited it with a receive payment form directly into the bank, as opposed to putting in the undeposited funds and then depositing them in some grouped format. So that's what we see here. We see the two received payments, right? We see the two received payments for those two invoices. If I was to open up a payment, then I'm not seeing a deposit form, even though it was deposited into the bank, but it's being deposited with the form of a payment form, a receive payment form, which is the second step in the process. And then this going to the other side, receive payment, by the way, means accounts receivable is going down. So this would reduce the accounts receivable. And the other side then going to either whatever account we assign here. Typically, undeposited funds is what we often use to group things up as a clearing account. It goes into undeposited funds here, back to our flow chart, and then we would deposit them in the grouping that we think would be reflected on the bank statement. But we could just deposit it directly into the checking account, which would be fine as long as we could match up these payments to the deposits in the checking account, as we're doing with the bank feeds here. If it's too complex to do that, we should group them up into undeposited funds and then deposit them. So that's going to be this item. If I close this back out, then the other side of that, if I go back up top, I'm going to go back to our balance sheet. The other side is going to be in accounts receivable. So in accounts receivable, and I scroll down to 4-3, there's our two payments for Anderson. It's going to be reducing the accounts payable. Right, and then if I look at the income statement, if I go back to the income statement, or the P&L, the profit and loss, and we take a look at the sales, and I go into the sales item, you'll note that we entered the invoices as a 4-1. The sale now is not being driven by when we got the deposit, but when we made the invoice. So these are the invoices that we made and then received the payment on it. Going to go back to our report summary. Let's open up another report, one other report that's going to be supporting the accounts receivable. I'm going to hold down control and scroll back down so QuickBooks doesn't do anything funny. I'm going to go down to the reports on the left-hand side, and I want to look at a customer balance detail report. So I'm going to type in customer balance detail so we could see this item. And this amount is going to be supporting the accounts receivable number. So the Anderson Guitars is here. If we scroll down to the bottom of all of our customers, we've got the 11,934. If we go back to our balance sheet then, and I scroll back up top and I go back to our balance sheet report and look at the accounts receivable, we have the 11,934. So remember, the accounts receivable represents people owing us money. It's also an accrual account. If we were on a cash basis, we wouldn't have accounts receivable. It's an accrual account by definition. So if we're on kind of a cash basis, possibly for the vendor side of things, like when we make payments, we may still want to be tracking the accounts receivable on the invoicing side of things, and we may want to be using the invoices in order to help us to bill people, to send out basically the bill. And so we have to work that into our system. So in this way, we can track, if we're using this kind of system, we can kind of track the accounts receivable and be more on an accrual basis and use that tracking here, and then have the supporting data in our transaction detail reports or the customer balance detail. We can also find this if I open up the old hamburger over here, and then we go into the sales item, and we go into the customer tab up top. And we can say, look at Anderson in this case and find the Anderson activities. We can also track, I'm going to close up the hamburger. We can track the invoices here as well as the payments on the invoices. So this is a useful way to be able to track this information and use the bank feeds with it. Now, next time we'll take a look at a similar situation, but let's say we have the invoice and then we have the received payments. And then we'll use the bank feeds for the deposit. So similar kind of situation. We could do both of these items. We can create an invoice and then go to the receive payment, record the second piece when we receive the payment, and then again use the bank feeds to do the last piece to tie out to the receive payments. Or we can take the receive payments, actually group them, and deposit them in the same kind of format as we expect to see on the financial statement. So next time we'll take a look at those.